In terms of plan for this morning, we'll give you a very brief update on the exec summary. Penny will take you through the numbers, and then I'll take you through a bit more detail in terms of the execution of the strategy. In terms of the business performance, I think the kind of key takeaway for me is that the reshaping of the business has been undertaken in the last 12 months. It's been a very transformational year for us. And when you start to look through these numbers, it is fundamentally a different business than the business it was 12 months ago, but very much in line with the execution of the strategy we stated to do. So if you think about what did we say we were going to do, have we done it, and has that delivered a business which is a different in terms of shape and therefore valuation. I think key things to call out are that more than half our revenues now come from outside of the UK. That was one of the key things we wanted to do in terms of diversifying our exposure to the UK marketplace. 70% of our revenues are now in the media division. Remember when that was inverted and 70% of our revenues were in the magazine division. We still love the magazine division. It's a huge asset to us in terms of our strategy and in terms of the valuable IP we get from it. However, we're very pleased to be 70% into the much higher margin part of our business. One of the things we fundamentally think is really important is audience growth, and I feel very encouraged by the fact that the organic, so the legacy portfolio audience growth is up 25%. We really do feel like we're writing the content that our audiences want to read, and there's no better endorsement of that part of our strategy than the growth in the organic numbers. However, in absolute terms, we've actually nearly doubled the size of our audience overall as a group, so we're very much reaching twice as many people as we were before. I think one of the things we talk about from a strategic perspective is operating leverage, and I think you'll see really clearly today that the platform that we've created both technically and operationally is working, and you see that come through with the EBITDA margins where they are. So we 6 percentage point improvements on our EBITDA margin really goes to that point about the operating leverage and the scale within the business. And then finally, the acquisitions are on track. So again, the final part of our strategy is to grow through acquisition as well. And we're very happy with how they're progressing, and we're very happy with the latest additions, Men in Lycra and Blackberries, which I have back at my desk, which I forgot to bring along today. I feel like I've disappointed everyone by not bringing my Blackberry, but we think it's the new mobile phone. So with that, I'll hand over to Penny.
Hi, good morning. So you'll have to excuse me a little because I've got a bit of a cold this morning, so apologies, and I'll try not to sneeze too much down the microphone. But happily, the numbers talk a little bit for themselves in that we've got, very pleasingly, some really strong results to be able to present to you today. So to Zillah's point, I mean, one of the key things that we've been focusing on is improving the operating leverage in the business. So really nice to see the revenue doubled to 108 million, but much more pleasing to see the EBITDA has increased by more than that to 23.7 million. And that's really, you can see that in the step change in the EBITDA margin, up 6 percentage points to 22%. And then the other point that we're always very focused on is making sure that that flows through to cash. So free cash flows, which is operating cash flows after CapEx, are 27.5 million, so a much higher cash conversion than we'd perhaps expect. EPS growth has been strong, up 92% to 20.5p, and the strong cash flows has helped us de-lever very quickly, so we're just over 1 times on leverage at the end of the first half. Just moving on to revenue in a bit more detail, and this is the first time that we've presented the results, including the impact of IFRS 15. So we've restated the prior year comparatives. It's not a significant movement for us, about 3.5 million. So just a gross up of where we've netted off some agency commission in the past. So 2 things which are very much a reflection of the strategy around diversification, which is the significant growth into media, now 70% of group revenue, and as Zillah mentioned, US is now more than half of the revenue. So you can see the acquisition, so we made 3 acquisitions in the course of last year, which are having a big step change on the revenue numbers. So the B2B business, New Bay, some titles from Haymarket, and then Perch we acquired at the very end of last financial year. So that's driving a good chunk of the revenue growth. Although underlying organic revenue growth, which we've included here at constant currency, has been very strong. So total organic growth of 14%. and in the media division, 38%. So some really great results. And you can see on the little pie chart there some fantastic results, both from e-commerce, 79% organic growth, and also digital display advertising at 34% organic growth, which is really the move into the US and very much focused on the monetization of that audience is reflected there. Mags declined at 11% after the impact of IFRS 15, so 10% without that, so very much in line with our expectation and the trend that we've been seeing. But that's overall contributed to the 14% organic growth. So we can see how that then, on this next slide, flows through to profit. As media gross contribution is now 3/4 of the total gross contribution because it's so much higher margin than the magazine division. And that and the significant decline in overheads as a percentage of EBITDA is really what's flowing through to drive the step change in EBITDA and that increase in the EBITDA margin to 22%. So the media margin has declined a little bit, which is as we expected and guided for the impact of Perch Publisher Services. That's where we're repping the inventory on behalf of other publishers. So we take the revenue and then we give away 80% of it. One of those and the most significant partner within that division is Mobile Nations, which we then acquired in March. So we'll see the impact of some of that reverse in the second half as we start to consolidate those results. But magazine margins, they improved slightly up to 63%. But overall, you can see that the media margin still remains much, much higher than the mag division. So as we see the change in the revenue mix shift, that flows through to the bottom line. So just highlighting the point that we've both made around increasing the operating leverage in the business. You can see from last year to this year just that step change in the EBITDA margin, the PBT margin, and also CapEx as a percentage of revenue. So we've stepped up the total quantum of CapEx a little bit, but as a percentage of revenue, that's quite a significant decrease as we change the scale of the organisation. So we're increasing revenue per head, we're increasing the margin, and CapEx as a percentage of revenue is declining. So you really see the benefits of the operating leverage flow through. I was listening to a podcast by Jim Collins on the way here about flywheels. So I've got flywheels in my head. So this is very much our flywheel as we step up the scale, you see it flow through. So moving on. We've got we can see the growth in EBITDA and that margin just on a 4-year trend. So you can really see the benefits of that flywheel. Now I'm on this theme, kind of paying off as we increase the scale, we increase the EBITDA margin. And then as we look at that in terms of cash, maybe slightly lumpier, but we can see that flowing through to cash as well. So this is the free cash flow. So operating cash after CapEx really stepping up as we increase the scale of the group and increase the scale of the diversification. Just looking at the cash flow in a bit more detail, we've seen overall that cash has been really strong with the operating cash conversion at more than 100%. I think the only other point just to really highlight on here is the acquisition. So 42 million of acquisitions, which was the acquisition of Mobile Nations in March, largely funded out of cash. And then also the cycling titles, much smaller, so 1.7 million for the cycling titles. And then we have a deferred consideration on Mobile Nations, which is payable after the period to March next year. So we took out an FX option just to hedge against that currency exposure. But otherwise, cash has been strong. On that point, we refinanced in Feb, which we announced at the time. So we now have a 90 million revolving credit facility with a 45 million uncommitted accordion facility. So really, as we've stepped up the scale of the business, we've been able to give us more balance sheet strength. I think one of the key points to highlight was we're at 1.1 times leverage at the end of the first half. We feel comfortable at around up to 1.5 times. We potentially have the ability to go up with an acquisition spike, but that's the sort of level of leverage that we feel typically comfortable at. But we've got lots of balance sheet strength. So in summary, really strong first half, significantly changed the scale of EBITDA and stepped up the margin. So together with the refinancing and the return to the premium listing, we really see a significant kind of step change in the group.
Thanks, Penny. I did promise you a sport-filled set of pictures today. So my other next biggest passion is football. So I'm not sure if we're Tottenham or Liverpool at the moment, but we're definitely going to win. And then flywheels. It's as if Penny and I had rehearsed this, right? So most of you are familiar with my wheel in terms of strategy, and I think almost everyone's seen this slide before. I make no apologies for being boring, but also efficient in terms of how I spend my time writing decks. We're just really focused on executing on our strategy. Someone was asking me this morning about, is there things we wouldn't think about buying? And there's lots of things we won't buy because there's lots of things that don't fit with our strategy. And a really clear focused on what we do and what we do successfully, which we know how to execute, is I think what underpins these numbers. And so that's why I come back to the strategy from perspective. If you just look at the wheel in a little bit more detail, just to recap on that point, each wheel in essence represents one of our audience verticals, be that tech, be that gaming, be that music, be that media tech in the B2B portfolio. And what we're trying to do is then, with each of these spokes in the wheel, find a monetization route. And we feel that what we want to do is buy audiences or buy into verticals or build verticals where we can pretty much fill every spoke and have a complete full set of diversified revenues. And that's pretty much what we're setting out to do. And the content and then how we use the data to help think about that content is what drives that. Our strategy remains to be a global specialist media platform. The emphasis is on specialist. We don't really like mass market. We don't like things that are highly commoditized. We believe in our brands. We believe in market leading positions. And we believe in the communities we talk to. And so that's a core part of that engagement. And then in growing our business, we see ourselves doing that through organic growth, which Penny's talked about, ongoing partnerships, and then where appropriate through acquisition. And then finally, we try very much to drive a diversified business model across all the revenue streams, but those being material. However, again, I was just talking to Jonathan earlier about something. I was saying that sometimes the strategy is the easy part, and I think lots of businesses know what they should do. I think the piece that sometimes gets complicated is how you execute on that. And it's very easy to get distracted by new things and kind of forget actually what it is that you're good at and how you execute against that. And so I think it's really important, again, to kind of come back to the 4 core pillars that underpin how we execute on our strategy. I think that, we'd be remiss to say how much we focus on this within the organisation. I spend 85% of my time, if not more than that, thinking about how do we execute on our strategy rather than on how we should evolve our strategy further. The first 2 here, diversifying our audience and scalable platforms, are kind of probably what I would describe as the core pillars that drive the business. We write content. We're a media company that writes content, and therefore if you're not engaging with your audiences and diversifying your audiences, you're going to have a problem in sustaining your growth. And as Penny said, our audience growth has been pretty terrific this last 6 months and has continued to be on the back of that. And that happens not by accident, but because we think about how do we diversify our audiences further. So the acquisition of cycling brands, the mobile nation brands, the growth of B2B business, but also within the core, I was looking at how can we expand out. So within the music portfolio, making sure we're covering, end to end in the music arena, or within the gaming portfolio, we've recently doubled down editorially on tips. For all of you gamers out there, you know what that means, but otherwise what that means is basically how to cheat at gaming. But it's dressed up as tips, but that's actually driven really significant growth in our gaming vertical over the last 8 to 12 weeks, and it's been an area of investment for us. So really thinking about, is there any part, being humble enough to look at the competitors and think, where are we not writing that they are that we could win at, and then doubling down on those areas. And in a scalable platform, you don't grow at the rate we're growing unless you've built infrastructure and scalability into your core business model, and having a scalable platform is really core to us. It's not just about the technology, it's also about the processes that underpin that. And so the standardising the model through the playbook approach, whereby everything which we think is core to future, we try and standardise and productionise so that anyone can come in to the business new and pick it up. But it is also around continuing to invest in the platform. I'll come on to that in a moment. Sufficient to say we added 3 new sites to Vanilla in the last 6 months, and we are about to go live with 3 over the next 6 weeks. So we're in peak migration season as I speak right now. The next 2 pillars, 3 and 4, are probably more around the further growth of the strategy. So how do we continue to diversify our content monetisation, and how are we thinking about innovation within the core business? And so I just highlighted here that we are very much investing back into the business. We're not just taking all the profit and showing it and then there's nothing for future. We very much are always thinking about how do we continue to deliver these growth rates in years 2, 3 and 4 and beyond. And so some of the things up here like premium content online, so some of our B2B sites have paywalls. How could we do that better? How do we access that more? We have sophisticated audiences that use ad blockers. We have been looking at and been quite successful actually with a number of ways to monetize around the ad blockers. Language formats, I think we've talked about before. We've got a significant trial going on just now around Hispanic. It feels like a natural audience extension for us. E-commerce B2B services, so we write about best broadband. That kind of leads you into, well, why not write about the best antivirus? It sits within the technology portfolio in terms of where we are, but it has a much higher CPA attached to it. And then, as Penny mentioned, podcasting. When I look at the spokes, one of the areas where I think maybe we're missing out is around audio. And so we're thinking about what can we do around podcasting. And through the acquisition of Cycling News, we actually acquired a 1.2 million podcast downloaded skill set, particularly around Tour de France. There's a lot of activity around that. So we're seeing that as a really great opportunity, both with the Cycling News and the 442 population, to really think about how can we trial podcasting more. And in fact, we just hired someone for on a 3-month basis to help us think about how we produce all of that content and monetize that going forward. So lots of ongoing investment in the core business, I think, is the key thing, which leads me nicely on to point 4, which is the ongoing investment. And so we continue to invest in tech. I'll come on to talk about that. We launched a new event during the course this year, so we really are thinking about across the portfolio, how can we seed what I talk about as Horizon 2 or Horizon 3 revenues. One of the other things is continued investment in people. And as you look at the business and you think about what's happened in the last 12 months, one of the things we've done a couple of things. One is across the senior management team, we made a decision to invest in 1 additional head at the layer below us. Whether we had a job vacancy or not, we just decided we needed to actually bring in some bandwidth which would help us during the next phase of our growth. So everyone's been out trying to hire. In fact, Penny, I think your new FD's here, isn't he? Does he want to?
First day.
He's not listening, however. You can wave your hand. And so that's been a really important part of us recognising that increasingly we can't do it ourselves. We have to have our teams to do it, and therefore we have to have the scalability in those teams. And then within my own leadership team, I've made 2 hiring appointments in the last 2 weeks. The first one is Jason McClellan, who comes in as IT and Operations Director. So that means that Kev, our CTO, can focus on engineering. That's where Kev is genius, and that's where he adds his value. And quite frankly, I don't want Kev worrying about software contract renewal rates, which is what he's been spending his time on. It's a waste of his intellect and skill. So instead, we've hired a chap called Jason McClellan. I'd actually worked before at Fitness First 15 years ago, who's a seasoned IT director professional, but he's also going to take on some of the day-to-day operational friction in the organisation, which will help us get that sorted out as we get bigger. And then finally, Simon Jackson, who's here. Simon's tired of me introducing him, right? So please get a chance to speak to Simon at the end, who's our Chief Commercial Officer. And Simon joins us from Sky and most recently GameSys, with an experience in marketing and subscriptions and monetisation models. And Simon's responsible for kind of growing our monetisation path and putting more spokes in our wheel. So it's really great from our perspective to have that additional capacity in the organisation. So coming back then to content and where are we in terms of our audiences, normally we kind of flick through this slide. I just wanted to draw a couple of points worth mentioning. The first one was about how much not only do we want to have the biggest audiences, we also believe in brand leadership. We think it's a defensive position. And at the moment we have leadership positions in PC gaming, space, photography, renovations, music, and tech, i.e. all of those boxes have market leadership positions in the UK and many of them in the US, and we think that's core to our strength. I wanted to briefly spend a little bit more time on our B2B portfolio because I think last year we kind of didn't really spend much time on it, and to be honest, it probably got dwarfed by the Perch acquisition when we were talking to many of you. So we put a little bit more detail on here. So just to draw out again, it's exactly the same strategy, the B2B portfolio, as it is with the B2C. We're looking for leadership positions in the niches in which we operate in. So at the moment we have the #1 TV conference in the US, which is New York TV Week in October. In our audiovisual vertical, we have the #1 position in AV technology in the US. Music Week is the #1 music publisher in the B2B industry in the UK. And consumer technology is the #1 B2B consumer technology title in the US, and it includes the publication of the CES show daily, CES being the biggest consumer electronic event globally. We actually run the show daily on that. So we really definitely have leadership positions, and as you listen to me talk about those verticals, what you've heard is them being very similar to the ones we have in consumer, which is back to this point around not just diversifying into B2B, but also, if you think about our wheel, expanding that out and owning the entire wheel, both the audience on the consumer side, but also on the audience in the B2B side. So we become truly expert in the niches that we work in. So I promise more detail on the tech stack. I know you can't wait for it. We've tried to make this a little bit easier to understand, but it's a really core part of our business, and so I think it's worth making sure people understand how it functions. There are kind of key 3 things that the tech stack enable for us. The first one is revenue growth, the second is audience growth, and the third one is operating scale. And going left to right, the assets box is really about how we protect the content that we create, how we manage the IP, how we make it discoverable. So once we've migrated magazines into the asset register, or we've written some content, how does everyone globally access that easily? And how do we make sure freelancers, we actually commission that content and own the rights to it forever as opposed to one time only? So that's what the asset stream of our content strategy is all about. The next one, which is the website stream, is all about the content itself. How do we distribute it? How do we sort it? And how do we present it? So things in there around how do we create the website? How do we make sure it's content localized, i.e. if you're in the US, you see dollars rather than pounds, for example. How do we make sure that the tagging, so how does it bring content together? How does Google think about it? How do the advertising groups think about it? All works seamlessly. And then the content management system, the CMS, is where the editorial team actually post their content into. How does that work in the aggregate? So that's what the website part, which we call vanilla, but it's actually much more than just one thing. It's an aggregate of lots of modules. And you'll see a little new there, which is Flexi, which Kev, our CTO, talked about the Capital Markets Day, which is really about how do we build the website builder faster, and he demonstrated in the Capital Markets Day the speed in which we can create new websites, and that really helps us structurally improve the way in which we migrate going forward and makes that easier to do. And then the final piece, close to my heart, is about monetization. So having protected the asset and made sure we can distribute it, how do we then monetize it? And from that perspective, we have 2 primary monetization routes: online, e-commerce, and ads. No change to Hawk at the moment, but I just wanted to call out Hybrid. We really thought hard about that name, which is the new advertising tech platform, which is the best of Bordeaux and Ramp. That one came from the finance guys in the corporate office rather than the devs, you can tell, right? And it really is best of breed. It's Bordeaux is all about quality of ad unit and frequency of ad unit, and Ramp is all about quality of advertising agency partners. It's all about the demand partners and the floor pricing and how that works. And so they're doing quite different things in the advertising universe, but together you have this kind of best of breed, and that's what we've developed with Hybrid. Briefly on revenue diversification, sometimes we get asked about why do you want to buy more brands, or why are you launching more brands in verticals you already operate in. It's a really core part to our strategy in that we operate in specialist verticals, but some of those verticals are 100 million plus large in audiences. Now that is not a one-size-fits-all approach, and so what we're trying to do is then within that audience where we have market leadership, really segment down into the super niches. So for example, what Hi-Fi is all about high-end audio, Laptop, the clue's in the name, it's all about pretty geeky laptop stuff. Digital Camera World talks to the camera enthusiast, whereas Tom's guide talks to the generalist electronics consumer. And so that's very much what we're trying to do in terms of our strategy. And just using the tech portfolio as an example, you can see that Only 18 months ago, TechRadar was 93% of the audience in the tech websites. That used to cause me a little bit of concern. I felt a little bit overexposed to TechRadar. I thought it was a fantastic site, but I wanted to diversify a little bit. You look where we are as of December, and TechRadar's 32% in the group. TechRadar's growing double digit. So TechRadar's not getting smaller. It's just we've added more around it, and we're growing overall in that position. So suddenly we feel like we've got lots of very niche techs, and Antech's quite a geeky tech site. T3 is mainstream lifestyle tech. Tom's Hardware is getting a bit more geeky, and then Tom's Guide and Tom's Hardware play to mass market tech, but with slightly different audience purposes, which is, again, really helpful. So another core part of our strategy was expanding into the US, and we talked about that a lot in the last 12 months, and I think, one could argue job done, although it's never done, right? 42nd Street is actually where we have our office, so that's why we put it up there. It's not because we're planning to go to Broadway, but it's a great location and we really like it. In terms of market position in the US, we now have leading positions in the US in terms of number one in tech space, PC gaming, and in B2B, AV tech, consumer tech, and our TV portfolio. So we're a market leader within the US, as well as having scale, which is really, really important. And then just in terms of our acquisition strategy, we actually acquired 3 businesses in the last 12 months. So the first one was the B2B portfolio Newbay. We then acquired Perch brands in the late autumn, and then back in February we acquired Mobile Nations, so further strengthening our tech portfolio. Within that, we acquired 5 offices. We're now back down to 3. Soon, I think, down to 2. But the whole point is that, our business is about keeping our business simple. So our job is, when we acquire things, to take the complexity out and then go back to our core executing model. We acquired, I think, somewhere on a slide it says about 500 colleagues. We actually we're our net at 356 just now in terms of new employees. The actual US headcount in total is 369. So you can see we've taken out a lot of the back office functions and moved them to the UK in terms of where it's a lower cost of labour. It's about twice as expensive to operate staff in the US. So we only want to operate staff in the US who genuinely are value add and need to be there, where it's something which we think is can be done from any location. We're going to bring that back to the UK in that respect. And then we've continued to share expertise and standardise our business model. However, it's not about buying stuff or having big audiences, it's about monetising those audiences, as I was saying earlier. And so how have we gone about monetising the US audience, I think, is the key point. What you can see in the top box is organic US revenue, so that is the legacy sites prior to the acquisitions. And what you can see is our US, our organic revenue is growing very healthily. I think key point to point out is our US audience growth is really pretty fantastic at 34%. And I would remind everyone that the vast majority of our colleagues are actually sitting in the UK supporting that growth. So we don't believe you have to be in market to talk to the right audience. We actually hired 28 new roles into the US, excluding the acquisitions, where we felt a need to actually hire more talent, particularly around sales and editorial in terms of how we're going around that. And then e-commerce is up still over 100%, and digital advertising, slightly disappointingly, isn't quite 50% growing organically, right? Must try harder. But joking aside, really plays back to the effort we've been focusing on making sure we're monetising that audience as hard as we were monetising the UK. And then our favourite statistic around ARPU, you can see in the chart, we continue to have this gap between the UK and the US. However, we're quite pleased with that because everything's growing. So long as everything's growing, that's good for us. And actually the US growth is 40%. So we're very pleased with the pace of that growth in the US in terms of our ARPU. Moving just briefly on to the acquisition strategy, I'm not going to talk about home interest ever again after today. I don't often make promises, but that's a promise. But I wanted to just close out on it because it's actually 20 months since we acquired this business. And so I think it's really important that people feel that we kind of close back with the investment case on what we said we'd do and did we do it. And our strategy is very much about buying things where we believe we can add value. And I think this is a case in point where we added value. So we bought this business from Centre Media Group 20 months ago. Since we acquired it, we fully integrated it. We've launched a new event in the home improvements. We've also got a new event scheduled and booked now for 2021. We launched a new website and we've repositioned the magazines, including a relaunch of one of them. Total revenue in the home interest portfolio is up 6%, which includes the magazine portfolio, which was half of the revenue when we acquired it. So if you put that in context, to have overall growth of 6%, is really pleasing year over year. Suffice to say, the contribution is double digit in terms of where we are year over year. So we're very pleased with how we've performed with that. Now, if you think about 20 months ago, we did that acquisition. Since then, we have done 3 or 4, I think 4 acquisitions subsequent. So when we're doing new stuff, we're not forgetting about implementing and demonstrating the growth on the original business models of what we have, which nicely segues me into Mobile Nations and Crackberry. I never thought I'd own a BlackBerry again. So what did we buy? So Mobile Nations was a partner to Perch. We knew the business well. We already were selling it, as Penny mentioned. It's one of the reasons why the margin in media is slightly diluted. They decided they wanted to sell. It's a really nice business, 2 founders, incredibly well run, really, really pleasant individuals to work with. About 8 million of EBITDA was our pro forma. We acquired it at the end of February. There is an earn-out on the business, as Penny mentioned already, and we're really pleased with how the business is performing today. Because of the earn-out, we are operating a little bit at arm's length in some of the commercial arrangements, because I don't want to tell them all of our good stuff and then pay them 10 times for that, right? So there's a turn to come in 2020 when we come out of the earn-out, and we can then put our best practice in place. In the meantime, what we've done is implement all the control measures we normally would do, so the finance function's fully integrated, and we have all our normal monthly financial review meetings and quarterly business review meetings. But at this moment in time, the optimization in terms of how we add additional value from a commercial perspective is sitting more like 9 months away, which gives us lots of time to think about how we can absolutely make it, stellar when the time comes. Although we're actually learning quite a lot from them, so it's really been helpful to find out about how they run their business as well, and so we're bringing that back into the house. And in Cycling Nations, we actually acquired, I think, officially on the same day. We did both transactions. We bought 2 cycling brands. We've had a stated intent to want to move back into cycling. We actually used to own these assets. They're very familiar to us. Half the staff that came across were actually originally Future people, so that was nice. It's about £2 million of revenue. The margins are about 20% in terms of EBITDA, in terms of what the contribution is. What we're really excited about here is the ability to start to really drive into this new vertical now and build out from that, and having built this platform of specialist expertise. So we fully intend to launch, I expect, a couple of new brands around this. And I think that the guys we acquired from an editorial perspective were slightly surprised to be involved in a business where the first statement was, how many people do you want? Which quite often in the media world, that's not what's happening in brands. And so they've been really excited about that opportunity. We believe there is value to add in being in mainstream cycling. We also believe there's value to add in being on the vanilla platform for the existing brand. As I said, they've got a wonderful podcasting business we can learn a bit from and use that to leverage off of. And we are going to migrate to vanilla after the Tour de France for no reason other than we just don't want to put the Tour de France at risk. It is the peak trading for this part of our portfolio, and there's no urgency from that perspective in terms of this is a Horizon 2, Horizon 3 growth opportunity. So I'd rather keep our advertising partners happy and keep our audiences happy than put anything at risk. Which brings me then on to the Perch acquisition, which was completed on the 4th of September, so coming up for 9 months now. So pro forma EBITDA in terms of what we bought was $10 million. It's really helped us strengthen our position in the US in terms of taking that market leadership position. We've been really pleased with how this is going so far. We've added so far lots of value, but still lots more to come. We did say at the time we did the acquisition we were going to take the migration slowly. We didn't want to interrupt peak trading, and I think the results have been through suggest that was the good decision to make in terms of our peak trading performance. In terms of where we are, we've got all of the control integration work is done. We're running as one business and one team. We have migrated all of the Perch forum sites across, so Perch have a high degree of user-generated content around forums. It's really highly valuable. It's one of the things we don't have at Future, which we are actually in the process of rolling out. However, it wasn't GDPR compliant and it wasn't scalable, so we've sorted out that part of the business. We've migrated space.com to the vanilla platform, and the results have been very pleasing in terms of audience and monetization. So we're very pleased with how that's gone. We have developed hybrid and now rolled hybrid out to the legacy vanilla sites, which took place in April. So TechRadar, T3, etc. are now using the new ad stack. We will roll out the new ad stack to the Perch sites as we move them onto vanilla, because it's a simultaneous piece of work. We have 3 migrations due to take place in the next 6 weeks. So Top 10 Reviews is going live in 2 weeks' time. Tom's Guide goes live in 4 weeks' time, and then Live Science goes live in 6 weeks' time. So we've been kind of running in parallel the kind of 3 different migration paths. What we wanted to do was make sure we knew what ad platform they were going on to, otherwise you end up doing 2 lots of migrations. So we wanted to make sure we got the ad migration right in terms of the value attributable there. We also expect to have significant technology savings following the migration to vanilla. So as we talked about before, there's some of that driving the current EBITDA margin expansion, partly through to some of the overhead and software cost savings, but we would expect to have some further savings coming into next year. Which nicely leads me on to my exec summary. It is actually a record-breaking set of results, which is really pleasing. I'm quite modest, but I'm kind of secretly high-fiving on breaking some records. That's really nice. The business is in really good shape. I think our strategy is working, and the focus on execution is really coming through in terms of the delivery of the strategy. We are very much focused on market-leading brands, relationships with our audiences and relationships with our clients, and we think that's coming through in terms of the top line, and then also in how that drives operating leverage and ultimately into the cash flow, which Penny and I care about a lot. We believe that we buy businesses where we can add value, and we believe we're demonstrating that not only can we add that value and have a track record of doing that, but we do that simultaneously with continuing to grow the core business, and we do that because we've built scalable processes and technology platforms, and at this stage we see no reason to not expect the current trends to continue.